All right, welcome. Today we're going to dive into a system called market DNA. We'll be doing a visual walkthrough step by step, and we're going to see how this model is applied to a specific cycle for silver, also known as XAG. Okay, here's what we've got on the agenda. We'll start with an intro to the silver cycle. Then we'll cover the entry points for phase one. After that, we'll dig into risk and sizing. Then we'll look at the targets and projected returns. And we'll wrap up with future phases and some key disclaimers. Let's get started. Okay, first up, Section 1, the introduction to the silver cycle. So we need to know where we're starting, right? Well, according to the model, we are documenting the initial state of this asset. And this particular cycle is identified as XAG_2_1. So this is the chart we'll be referencing throughout. You can see all the geometric structures of the market DNA model laid out. Now, this is a snapshot from a specific date, February 5th, 2026. Everything we talk about, it all comes from what's right here on this chart. So, the big question is, where are we right now? According to the model, the current status for this asset is phase one. This is the very beginning, the entry phase for the entire plan we're about to walk through. All right, on to Section 2, Phase 1 entry points. Now we're getting into the real details. The model gives us two predefined entry levels to look at. First up is the primary entry. It's designated as level M, and the price for this level is set at $65. But there's also a secondary entry. This one is at level PC. Think of it as an optional level, and it's a really important piece of the risk management puzzle. That one is located at $43.56. Okay, let's move into Section 3, and this is a big one, risk and sizing parameters. You know, entry points are great, but how you manage risk is what really matters. So let's look at the inputs for the risk management plan. So this table here, this is really the blueprint for the risk plan. We're working with a hypothetical capital of $100,000. The max drawdown is set at 10%, which is a key constraint. Then you see these other model-specific inputs, a trapezoid time duration of 47 days, a three triangle domain of 90.72%, a risk coefficient of 1, and a contract size of 10,000 ounces. These are the ingredients, so to speak. And based on those inputs we just saw, the model gives us these calculations. You get a mean entry of $54.28. The expected low price comes out to $5.04, and that brings the total position size to 0.02. Now, it's really important to be precise about how these sizes are calculated. The documentation states this explicitly, and I'll read it word for word. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. So what does that all mean? It breaks down to a trade size of 0.01 for each potential entry. That's one for level M and one for the optional entry at PC. All right, Section 4, targets and projected returns. So we've covered the getting in part. Now let's look at the getting out part. We're going to examine the potential outcomes based on the model's predefined targets. The model lays out three clear exit targets. T1 is the first one at the mirror or lower trapezoid level, which is $72.04. T2 is at apex N, which comes in at $94.65. And the final target, T3, is the full exit at the trapezoid top, a price of $119.66. Okay, so let's project this out using two different scenarios. Scenario 1 is straightforward. You enter at M and you exit the whole thing at T3. Simple. Now, Scenario 2 is a little more complex. Here, you enter at both M and P. Then you exit the PC part at T2 and the M part at T3. And here you can see the difference that makes in terms of expected profit. In Scenario 1, the projection is $6,538. But look at Scenario 2. By using that second entry, the projected profit jumps to $11,647. Pretty big difference. Now, let's look at that in terms of expected annual return. Scenario 1 comes in at a projected 50.79%. But check out Scenario 2 again. That jumps all the way up to 90.45%. That really shows the potential impact of that second risk-managed entry. Okay, wrapping up with our last section, future phases and disclaimers. Let's see what the model shows for what might come next, and then we'll cover the important notices. So the model doesn't give a single prediction. Instead, it outlines possible paths. We're in phase 1 now. From here, we could see path A, which goes 2, then 3, then 4. Or we could see path B, where it goes to phase 3 first, then 2, then 4. The market will decide which path it takes. So, what happens next? Well, that's the million-dollar question, isn't it? We navigate the market from here. The next event is what will tell us which path this cycle is actually on, all within the model's framework. And finally, we have to go over some very important disclaimers. Please pay close attention. First and foremost, this is not financial advice. Leverage above 10 is prohibited, and you should never invest essential personal funds. This analysis is purely for public documentation and verification of the model, and any risk management has to follow the provided instructions exactly. And that's our visual documentation for phase 1 of the silver cycle. If you'd like to see more documentation, you can head over to marketdnaedge.com. Thanks so much for tuning in.